In this video, we're going to go over the real numbers that I made in 2023 selling cash secured puts and some covered calls. And we're also going to go over a quick demo in Robinhood to show you how I go over my options trading and how you can start a watch list for free to keep track of your options as well. Now, this is not financial advice. This is purely a strategy I use personally, and I am trying to keep myself accountable on my actions. So if you go and search for the wheel strategy, you'll see claims like $6,000 a month, $1,000 a week, $5,000 a month. And the wheel strategy is a way to generate income by selling put options and selling call options. So let's just get right into the numbers here. So for 2023, my total income was $20,510 pre-tax, and that comes out to about $1,709 per month. Let's take a look at how I got into these numbers. So I used a very low risk wheel strategy for this because I did not really want to get assigned. I was afraid that in 2023 there was going to be a bear market, a recession was going to come. Everybody was saying recession. So I took a lot less risk. Had I taken on more risk, I would have had better returns. So the days to expiration was about 30 plus days. My delta was around 0.1 to 0.15. Regular wheel strategy, the delta is about 0.3 because you kind of want to get assigned. But I did not want that risk, so I went with 0.1 and 0.15 on average. Now my main tickers were the QQQ and the SPY because, again, I did not want to get assigned on a single stock. Although I did start increasing my risk towards the end of the year, once the Fed had turned dovish and saying that there's going to be a Fed pivot, I did start increasing my risk and buying a lot more like Nvidia and Tesla and Coinbase, or not buying, but selling more puts on individual stocks. But throughout the year, I mainly did QQQ and SPY just because those are index funds. And even though you earn less money for those index funds, it is a lot less risky than one single stock. All right, so let's look at some of the positions I did. As you can see, a lot of these Nvidia ones were end of the year because I ratcheted up my risk tolerance. I did so I'm on Apple. This is not a comprehensive list. This is just a quick screenshot of some of the things I did. But QQQ there at the bottom is most of my sells. Now you can see here the total short position was $11,817. So throughout all of 2023, I never really got assigned anything. I was just constantly selling those puts because of the low delta. I was not getting assigned at all. So I didn't get anything assigned in 2023. However, at the end of 2022, I was assigned. And in 2023, the beginning of 2023, I sold off those assignments. So as you can see here, end of 2022, I was assigned QQQ, SPY, and Tesla. And as those bounced back in 2023, I sold those off. I sold covered calls on those, and those got called away. And I am going to factor those into my proceeds here because that is part of the wheel strategy as well. You get assigned the shares and then you sell the shares back. Had I held onto these shares, I would have made a lot more money, but we'll get to that at the end when we go over the pros and cons of the strategy. And I also have a lot of positions that have not fully played out yet. So as you can see here for Palantir, for example, the expiration is January 19th of 2024. Since that date has not come yet, these options are still technically in play. I have gathered the premiums for it, but they're still under the unrealized gains category. Let's take a look at how I like to keep track of all of my options trading. I like to do it in Robinhood because they have this nice options watch list, and also because they have the best options chain. I don't really have any money in this account. As you can see, I only have like $1. Most of my money is in my Vanguard account, and that's because Vanguard has the best money market fund. But I like to keep track of everything in Robinhood because it's a lot easier. And the options chain in Vanguard is really not good at all. So if we click on the options watch list, you're going to see a list of all of the put options that I have sold, and you can do a search for a ticker symbol. So let's take example SPY, And you can do this for free as well. You can just open up a Robinhood account and you don't really need any money in it at all. So if you click this trade SPY options, this is going to bring up what's called the options chain. And you'll want to go and hit sell a put. And then you want to pick the expiration date. Now this is not a comprehensive overview of how to trade options. This is just a very basic overview. If you would like a more comprehensive guide, let me know in the comments below. What I like to pick is the 30 days out, at least 30 days. So that would be January 31st. What you could also do would be the third Friday of the month. So that would be the 19th, I believe, but that's only 22 days. But the reason you would want to do the third Friday is because that's when most of the financial institutions do their options settlements, and there's a lot more volume on those days. But just for demo purposes, I'm going to pick about 30 days out. So January 26th, that's like the last Friday of the month. So you pick sell the put, you pick an expiration date, and now let's take a look at what we have here. So we have the share price of SPY, SPY, right now at $477. There's a few things you'll notice. That here's a price, so this is the price for each options contract, and this is the strike price. Now the further out you go, down here it's called out of the money. The further down you go, the further out of the money you go, the less premium you're going to collect. That's because there's a less likelihood of this share price coming down to meet the strike price. In fact, for this example, 465, there's about an 82% chance that this 477 price does not come down to this 465 price. So let's click on this, for example. You'll see the delta right here is 0.2. So delta roughly translates into the likelihood of getting assigned. And that's where this chance of profit percentage also comes from. So if you keep going down the chain, what I was doing was about 0.1 delta, so that's 90% chance of profit, and that would be at the $455 strike price. And as you can see, the premium is a lot lower because there's a less chance of SPY, which is the entire S&P 500, tanking from 477 to 455 by January 26th. All right, there's a very small chance. In fact, there's only a 10% chance that would happen. That's why you don't get paid a lot of premium. But you do make up for that in that there's a lot less risk involved. So this is one you can add to the watch list. And when you add it to the watch list, and you don't have any real money in here, you can kind of pretend like you sold the put on this. So if you add it to the watch list, it's going to keep track of it with this little arrow, and you can keep track of a lot of things in the watch list. Let's take a look at one in my watch list. I have one for Coinbase. It's a $140 put, and it shows the expiration of 1/19/2024. And I like it because it says the average credit when added. So when I added this to my watch list, so when I actually sold the put on this, it was worth $4.03. Now with options, each contract represents 100 shares, so you need to multiply kind of everything by 100. So $4.03 multiplied by 100 is $403. So that is the actual premium that I collected when I added this to my watch list. You can also see that there's a total return here. Right now, this option contract is only worth $2.14. So I could go and close this position and I would have made a total of $189. As time progresses, right now it's like the 29th, as we get closer and closer to this expiration date, this options price should eventually tick down, and become zero. And when it becomes zero, your total return right here, it will equal the credit when you added it, which would be the $4.03. Multiply that by 100, it would be the $403 you would get in your total return. That's like one of the great things about these options watch lists, is because you can kind of keep track of all this stuff without actually having to buy or sell any put options at all. So what happens if that does not play out? What happens if the price of Coinbase goes down? So right now the price of Coinbase is $186, and you'll notice there's kind of like an inverse correlation. As the price of Coinbase stock goes up, the price of this option goes down. That's because the stock price of $186, this stock price is deviating further and further away from this $140 strike price. And as that happens, this will eventually become worthless. But what happens if Coinbase tanks from $186 to say $130, like below our strike price? If that were to happen, this would shoot up in price. So this contract, so right now it's $2, it might shoot up to like $8, multiply that by 100, and that would be like $800. That would mean you sold this at an inopportune time, because had you waited and had you foreseen that tank, you could have sold this put option for a lot more money. So when the stock price tanks, there are a few things you can do. You can just let it be and get assigned, which means the premium you collected is still the premium you collect. So nothing happens to this premium. It's already in your account. And then when the date arrives, this January 19th, when that date arrives, and if the stock price is still below the strike price, you will have to pay this $140, multiply that by 100, so that's like $14,000. You have to pay $14,000 to buy 100 shares of Coinbase stock at this strike price on this date of expiration. Now that is like a risk. If you think that it's going to bounce back up, then that is a risk you can get assigned with. Now remember, when you sell a put in the wheel strategy, you always want to sell it on stocks or indexes that you want to own. So in this case, I would be okay owning Coinbase at 140, and I would be okay owning 100 shares of it at 140 to be specific. But let's say you don't want to actually get assigned. Another thing you could do is called rolling out the option. And what you would do in that scenario would be you want to close out this position. And to close out this position, you would have to lose money and then add it back by selling another put option. So what do I mean by lose money? Well, right now, my potential profit that I have already made is $4.03. Multiply that by 100, so $403. If this were to tank down here to 130, and let's pretend that we know the price of this option, this would shoot up to, let's say, $800. Well, I would be forced to close this position and buy it back at $800. That would mean like a $400 loss, right? I would have lost $400 on this trade. But then what I can also do is turn around and sell another put option further down. So further down, maybe at 120 or maybe at 100, right? At a later expiration date. So I'm rolling out the expiration date. So instead of 119, I'll go to like next month, February or something like that. So I would choose a lower strike price at a later expiration date and sell another put on that. And hopefully that difference is going to make up for the $400 I lost. That does not always happen though. If it's a sharp drop, some other shenanigans happen, you might not be able to make back that money. So that is one of the risks of trying to roll out the options. You can roll it out, but not indefinitely, because at some point it's going to be a losing trade no matter what. Now in my case, I've always been okay with getting assigned. That's part of the wheel strategy. You kind of want to get assigned and you want to get a bounce back. But if you do get assigned and the stock keeps going down, let's say this stock goes to zero, that's why there's the max loss of like a lot of money, because you would have spent, theoretically, you would have spent $14,000 buying 100 shares of Coinbase stock. And if you got assigned and it went to zero, you would have lost that entire investment. In reality, that rarely happens if you pick a good stock or a good index fund. If you pick a good index fund, that will probably never ever happen ever, right? You're never going to see the S&P go to zero. That's not going to happen. So it may turn into a long-term buy and hold strategy at that point. If you get assigned and it goes down, you maybe just wait a year,
and hopefully it recovers. Wait 2 years, it may recover. At that point, you sell the covered calls on that, and that is the other part of the wheel strategy.
So let's go over some of the pros and the cons of this strategy. The pros was that it was very low effort and there was low time commitment. So what I would do is I would open up my Yahoo Finance and see if the markets are red. If the markets are red, then you usually get a higher premium for selling the puts. If the markets are red, and if they're really red, like down 2% or something, 2% negative on the QQQ and SPY is a massive move. You would get a lot higher premium for selling puts on that day. So if the markets are red, then I would go open up my Vanguard and sell a put. If they were green, I would close the app and go about my day. So that's basically what I did for most of 2023. I didn't really spend a lot of time tracking any of the markets or the Fed or any of that stuff. And also, it's a great boost on your uninvested cash. Because I had a lot of cash in my brokerage account, I was waiting for the recession to hit. I was waiting for the markets to tank so I could deploy that cash. And instead of just sitting there, well, it was sitting in the money market account, but instead of just sitting there just in the money market account, I was also putting it to work by selling these puts. Now, another pro is that it forces you to buy the dip. So if you're like me, you're waiting for the dip to happen. And when it does happen, the conditions are much worse than you thought. Think of COVID. When COVID happened, there was a huge market dip. I had a lot of capital, but I did not deploy it at once because the world was ending, like things change. The whole situation, the environment around you feels very bad. So you become hesitant, even though part of your brain knows that you should buy this dip. Your heart and your hand cannot click that buy button. So it forces you to buy the dip. At least it's a good thing for me. And you can tweak this strategy for your risk level. So if you wanted to dial up the risk, instead of buying QQQ and SPY, you can do it on Coinbase or Tesla, right? And you can also adjust the delta. So instead of 0.1 to 0.5, you can dial it up to the normal wheel strategy of 0.3. You're dialing up the risk, but you're also dialing up the reward. And depending on the economics, the macroeconomic at the time, you can dial it up or down depending on how you think the future may be. So what are some of the cons of this strategy? Well, it's not tax efficient unless you're doing it in like a Roth IRA or a traditional IRA. I'm doing it in a taxable brokerage account, so all the gains I have to pay taxes on, and they are short-term capital gains as opposed to long-term capital gains. So I have to pay a lot more taxes on these gains. Now, I am okay with that because I'm thinking of this as like a side hustle. If I were to make a real side hustle and drop ship shoes or something on the internet, all that money I make, it's effectively short-term capital gains as well. Any side hustle you do, you're going to pay taxes on that. So this is kind of like another side hustle. So in my mind, it's just fine. I'll just pay the taxes on that. But if you do like a buy and hold strategy, you will pay less taxes on the gains that you make. Now, another con is that this is not consistent, okay? All those YouTubes out there saying that you can make X amount per month. Well, I only made a good amount when the markets were red, right? When the markets were red and when the stock goes down, that's when you go to sell the put. And that doesn't happen all the time. A lot of times, like right now in December, the markets are green. And when the markets are green and the VIX is low, you don't get a lot of premium for selling puts. And you also don't get a lot of premium for selling calls when the VIX is low. So this is not a very consistent strategy. Some months you'll have higher returns than other months. And as I mentioned before, buy and hold probably wins out. So if we go back to my previous slide, as you can see that I had bought and it was assigned QQQ, SPY, and Tesla at the end of 2022. Had I just held on to all of that instead of selling the covered call and getting it assigned away, had I just held on to that, at this point in time, I would be up a lot more, way more, I would say, than what I'm currently up. And I get to pay less taxes because a year would have transpired, and that would be long-term capital gains. So buy and hold probably wins out. But again, we don't, like, looking back in hindsight, that would have been a better play. At the end of 2022, it was doom and gloom, recession, so you don't know what you don't know. And you can't regret just making profits, okay? So even though I couldn't have made as much profit, even though buy and hold would have won out, I'm still satisfied with getting something for those assigned shares. And now the last and maybe the biggest con is if there's a sharp market drop, then you could be left holding the bag for a long time. Now let me demonstrate this real quick. At the end of 2022, see this big dip right here? This is when I was assigned those Tesla stocks, right? I believe I had sold a 145 put option, so it's around here. I had sold the 145, and then Tesla just kept going down, right? It was a sharp drop, and when that happens, when Tesla gets to, like, the 113 mark, you have to buy Tesla shares at the 145, even though it's worth 113. So when it was worth 113, I had to buy it at the 145 mark. And then when you want to go and sell covered calls on those, since it's so far away from your break-even price, you don't really want to sell covered calls beneath your break-even price, because if those do get called away, then you're going to lose money. So if the stock drops sharply and it's really beneath your break-even, you can't really make a good profit selling covered calls on those. You're kind of left holding the bag. Now, looking back in hindsight, I should have bought more at this price because it bounced back up, right? But during the time, at the moment, you don't know that. You think it's going to keep going down. People are saying, oh, Tesla's going to $50 or whatever. You just don't know. And during that time, you're kind of like, get these shares away from me. I want to just make my money back. If another black swan happens, all these could tank really hard, and at that point the wheel strategy will effectively break. So that would be the main risk of the wheel strategy, is a sharp market drop will put you out of the game. The last thing I'll say is that for a index like QQQ, if a big index has a big sharp drop towards your 0.1 delta strike price, that means the stock market has dropped really hard, and you should probably start buying something at that point. Maybe you don't want to buy 100 shares, maybe you don't want to get assigned, but you could start just buying the index near those prices at a smaller nibble. So that is kind of when you're buying the dip. It's also a signal that there's a big dip, you should buy it. So I kind of wish I had not been so risk adverse, because I would have made more money. But hindsight is always, 2020, and you don't know what the market's going to do. So maybe next year I'll ratchet up my risk a little bit to get more premiums, and I'll keep playing with this strategy next year to see how things go out. If you found this video helpful and you want more on how to sell options, let me know in the comments below. Thanks.